This story has the perfect trifecta of all the things we're not supposed to talk about: money, politics, and religion, because crypto is not even money at this point, it's a religion. So this story is between two of the world's biggest crypto exchanges, FTX and Binance. Now Binance is the world's biggest crypto exchange. Last year they traded over $7 trillion worth of volume on their platform. To get an idea of just how big that number is, that represents more than half of all of the value that was exchanged in all of crypto in all of last year. And now FTX, by comparison, which was created by billionaire Sam Bankman-Fried, was the fastest growing crypto exchange. They helped bail out companies like BlockFi and Voyager this year. They spent an insane amount of money on partnerships with Steph Curry, Tom Brady. They did a Super Bowl commercial with Larry David, and they own the FTX arena in Miami. Needless to say, both of these guys are huge competitors of each other. Butin, a crazy turn of events. This week Binance saved FTX from total collapse. Here's how it happened. On November 6, the owner of Binance CZ tweeted to the world that as part of their equity exit out of FTX, they were paid roughly $2.1 billion in combination of BUSD, which is a stable coin owned by Binance, and FTT, which is a token owned by FTX, and that due to recent discovery they were going to sell their whole share off tokens. Then on November 5 someone noticed a massive transfer of 23 million FTT tokens inside of Binance worth roughly $585 million. CZ later confirmed that it was in fact him transferring this money because he was planning to eventually sell it, because he learned a lot from the collapse of Terra Luna and he wanted to avoid that potentially happening to Binance or being involved with anyone that might be at risk. This of course sent the price of FTT tokens to greater. Now Sam responded to Binance by saying that Alameda Research, which is a sister company of FTX, would gladly buy up each and every single FTT token, and that their balance sheet was perfectly fine. Of course, the next day things took a crazy turn. This all got started when a document was shared on CoinDesk about Alameda Research's balance sheet. And just so you understand, Alameda Research, FTX, and Sam Bankman-Fried are one and the same, even though they're different entities. They all belong to the same person. Now that document revealed that Alameda Research had roughly $14.6 billion on their balance sheet as of June 30 this year. Now that's a lot, but it was also revealed that most of their assets were held in their own token FTT that they magically printed out of. That $14.6 billion, roughly $8 billion, was an FTT. Now by that point before this whole collapse, the market cap of FTT was a little over $2 billion. This just means that even if FTX wanted to liquidate their assets, that they wouldn't be able to get anywhere near the value they claimed they had on their balance sheet. That's when things started to go south, and when everyone started to withdraw their money out of FTX. That's when FTX started to see a liquidity crunch, and by Tuesday things got so bad that Binance put out a letter of intent to unofficially buy FTX and to bail them out of trouble. CZ then tweeted that the lessons he's learned is to never use your own token as collateral, to never borrow money if you're on a crypto business, and to always have massive reserves. But in the meantime, everyone is wondering why things got so bad. Please understand that none of this is confirmed as 100 fact. This is just a working theory of how it could have all edgedly happened, and it goes something like this. This is the famous infinite money glitch, where a company creates a hypothetical token called FTT. They could then, after magically printing this magic money out of now, here, give it artificial value by giving it a use case, a utility, and then buying up a majority of its supply and then burning the rest to increase its value. Now after this token gets valuable, they could then hypothetically and allegedly send these tokens to their sister company Alameda Research, where they could then show on their balance sheet potentially actual profits and actual value, where they would then leverage that balance sheet and borrow against it, and they would borrow other assets, other stable coins, Bitcoin, Ethereum, whatever it is. After borrowing these assets, they could then send all of those cryptos back to FTs, and doing this you have created the infinite money glitch, where you could print as much money as you want. This could help explain how the value of tokens had such a huge effect on FTX's ability to liquidate, because this strategy works until it doesn't. if there's a run on the bank. And everyone gets scared and tries to withdraw all of their money all at once, then it's time to pay up, because when people sell they also have to convert their stable coins and their assets like FTT tokens into actual money. But if that platform, then it's to pay up, because when people sell they also have to convert their stable coins and their assets like FTT tokens into actual money. But if that platform,